Welcome back to Switzer on Australia's Business Channel. Markets are volatile right now on mixed economic data and uncertainty around bond yields, Greece and the Fed, with many experts predicting this trend to continue for some time yet. So what are the charts telling us? With us is the legendary chartist, Switzer regular, Lance Lai from Accountancy Invest, and he's here to share his technical perspective on China, the US, Australia and the dollar. Mate, welcome to the show.
Thanks, Marty. Great to be here.
Good to have you here. So you're a regular on the program. Last time you were on the show, you made some calls. What you said last time you were on the show was, and we're going to bring it up.
Sure. Okay. What we can see here is that it basically shot up 78% in 6 months. It's at 3,925. You can see here what I've drawn is I think it'll go up a little bit more to where that new T level is, which is 4,286. It's another 9% higher, and I feel that it'll come off and bounce between the T and now the S.
Okay, so that was the Shanghai Composite Index.
That's right.
You were talking about it last time we were on the show.
Right.
Tell us what you said and tell us what's happened since then.
Well, basically in 6 months, at that time it had gone up 78%. And the big question was, well, was it going to go up or was it going to go down? I think at that time I said it was going to go up, I thought by another 9%. And in fact, it went up almost another 30, basically from 2 months ago.
Wow.
Yeah.
So over the last 12 months, I think the Shanghai Composite Index has done about 150%.
Well, it might be in the last 18 months or 12 months, but in the last 8 months, which is where...
October.
Since November, it's gone up 118%. And where it broke out from the level where I thought we would hit the target, it hit it and just kept on going. Yeah.
Okay, so we're going to actually pull that chart up again. We're going to get your views on what's going on at the moment.
Okay.
So
there you go.
This is the Shanghai Composite Index. Talk us through what's happening here.
Yeah, all right. So you can see that you've got a very sweeping line that's yellow on the bottom. That's the 200-day moving average. Now, where it says T2333, that's actually the target level that I'd anticipated some time ago, and that I was actually quite positive that that would get taken out. What wasn't expected, of course, is that it would go up 118% in 18 months.
Wow.
And in particular, even in the last 2 months, for it to go up 30% is quite incredible, to say the least. So the 9th of April was the last time I was on the show. The T level represents a level that I thought it would go to and then come off and then come back into the T and S zone, which would still be a very impressive level to be at. But as you can see, it's actually broken through, broken back down and then gone straight up again, which is where we're at now at 5,085. And really, I think you can see from this chart it's really gone vertical, right? And the 200-day moving average, which is that sweeping line on the bottom there, is 37% away. And this indicates to me that we've really gone probably too far, too fast now, Marty. And where the S1 is and S2 is where I think it should really come back down and trade within that range. Now, S1 is 11.8% lower. It's 4,485. S2 is 3,674. Now, that's all the way 27% lower, which is quite a fair way. But as you can see, you know, to go up like this in a vertical sense is really not sustainable.
Yeah. So what do you put the drivers down to of this incredible growth in the Shanghai Composite?
There's no secret, really. We have the qualitative easing that's been going on since November, and then now we've got news in the last month that there's more quantitative easing. So the government is actually doing all those things to stimulate the economy, and this is really getting quite ahead of itself and probably too far ahead. I think they're going to be successful in this easing and the stimulating the economy so it doesn't fall over.
And they are starting to put some practices in place now, try and slow this down, rules around margin lending and whatnot.
Right. but I think you can see here, I think they've gone from, I suppose you could say, one casino to the other.
Yeah.
It's really gone too far, in my opinion, now.
Okay, so you said heading down for the next time you're on the show?
Well, you know, Marty, depends when I'm on the show next. But
we better lock you in.
but, you know, it can't keep going up like this. There needs to be some pause, and that would be a healthy thing.
Okay. So the US, let's talk through what's going on there.
Sure.
We've got a chart that we're going to bring up.
Well, what? Yep, okay, so...
This is the S&P 500?
Yeah, the US S&P 500. As you can see, this chart has stayed very nicely within the channel that we have there since November of 2012. It's also stayed nicely above the 200-day moving average, except that one time where it broke down and then it broke back up, where that S is. What you can see now, though, is that we're at 2,079. It's gone up basically 54.8% in two years and 7 months. That's a very healthy amount. And you can see it starting to break out of that channel that's been drawn for quite some time, and in fact starting to come back to the 200-day moving average. It's right very close to the S1, which is where the 200-day moving average is. That's 1.6% lower. I think it should go there, and then probably come back as far as 1,895, which is about 8.9% lower. When that will be, we're not quite sure, but I think, you know, first things first, I think it needs to come off a little bit more.
So you're tipping a mild correction?
Yeah, a mild correction, Marty. It's gone up, you know, 55% in over 2 years. I think, you know, to come back 9% is not a bad thing, yeah, and for it to go sideways a little bit longer.
Okay, well, talking about coming back about 9%, we'll go to our next chart.
Sure.
Which is the ASX 200.
That's right.
And since the start of the year, it's sort of come off probably after today's results, almost about 9%.
Right. So what we're seeing in all of these charts is a pullback of one sort or another. You know, on this chart here...
Except China.
Yes. Well, that'll come, Marty.
Yeah, we'll keep you to that.
And so now we're at 5,471. And you can see here that, again, we were kind of in this channel, broke below. We did a double bottom in December, broke back up, and now we're down again below the 200-day moving average as well. The
which can be a bad thing for going lower, can't it, in your language?
It can be, and you see, it means that the upward trend has been, I wouldn't say completely broken, but I mean it's certainly been tested here, and so you can see where we're at. I think we're sitting right on a support level. There's another support level slightly lower than that, you know, and I think we could go as low as that. Where on this chart, you could see, I actually thought last time we would go up, but I missed it by a few percentage points, and it actually broke back down. So I think what we're trying to do here is find some kind of a bottom.
Okay. Buying opportunity?
I think very soon, Marty.
Okay.
Very soon.
So we'll move along to our next chart, which I guess relates to the Aussie dollar, and that's something that means a lot for a number of companies listed on the ASX. That's the Australian dollar chart.
Yep.
AUD.
So the Aussie chart, when it comes up, there it is. I've taken this all the way back to March of 2009, and you can see in this chart we've got it going all the way from 64 cents on the left up to $1.10 up in the middle, breaking B, that bad line, Marty.
Breaking bad.
And that's the breaking bad. And then what we can see is that it fell once it broke that bad line, and it's fallen really all the way back down to where I see as support is around 77 cents. And, you know, we're currently at 76.47 cents, and I think we're near the support levels. And again, this is kind of like the Aussie chart. It's trying to find a support around here.
So do you see, you don't see that going lower? Because a lot of people are talking, currency going, below 70. Do you see that happening, or do you think we're more likely to stay around this level?
I can see that it's really fighting to try to stay above these levels.
Yeah.
And the reason why I've drawn that very long line is that we've gone back to a level which, we going back to April and May of 2009 levels. I know that the commodity story is very much caught in the Aussie dollar, and that I think is in itself trying to find a base as well. So there's a lot of, you couldn't say coincidences, but those are the factors that are driving it. And I think I'm confident that it probably needs to rest here.
So to summarise, we looked at 4 key charts.
Yes.
Shanghai Composite Index over the short term, you think it's going to come off?
I think this has gone into wild west territory, Marty.
Yeah.
And for it to go up another 10 to 15%.
Yeah.
Is certainly a possibility. Will it stay there without coming back? I doubt it. You just need to be a bit patient, I reckon.
Before we go, so US, you're saying 8 to 10% correction on the cards?
Yes, US is softening.
Yep.
I think the momentum also needs to come off a little bit so it can rest and go down before it can go up again.
Yep.
I don't think it means that we're going to have any crashes.
Yep.
And in the Aussie market, we're kind of like a little bit ahead of the pack almost, and gone probably to its limits, like the Aussie dollar, and probably finding a base.
Lance Lai, Accountancy Invest, thanks for your time.
My pleasure, Marty.
That's the show. If you want to read my thoughts each morning at the close of Wall Street, check out our website, Switzer Daily, which is switzer.com.au. If you want to get our thoughts on super, visit the switzersuperreport.com.au. And if you've got any questions for me or ones you'd like me to put to an expert, email me, switzer@switzer.com.au, or you can follow me on Twitter. The handle is @MartySwitzer. I'm Marty Switzer. Thanks for watching.